Hello, Sam. Good evening.
Good evening, Matthew.
Are you ready for this today?
Yeah, I'm good. How's your trading so far?
Yeah, it's been good. We still looking at the impact of the CPI yesterday.
CPI,
Today we had PPI, not quite much impact. It seems like yesterday's move moved the market much. I think we just had a small shakeup.
Yeah, I think for CPI it's usually more of an impact than a PPI. Mainly because that's what everyone is looking at with regards to the economy.
All right. To our dear listeners, welcome to our session. Today we're looking at risk management.
Yeah. I think this is one of the key aspects that a lot of traders tend to overlook. And at the end of the day, you know that trading is a balance of your returns and your risk. So it's a very fundamental aspect as a trader to understand how to balance your risk when you're deciding to enter into certain types of trades. So yeah, risk management tools. It's a very it's a very extensive topic. I don't know what you think, Mathew.
Well, it's really very important, but mastering it, someone has to practice for quite some time. It's really important for traders to note that risk is something you have to manage if you have to be better and be consistent in trading. Actually, any platform that you will see, you will always have a disclaimer that trading with margin products, it's risky. So by the fact that it's one of the things that you're told right from the beginning, then it's really very imperative that you learn how to manage the risk. And today we're giving the tools that someone will need.
Yeah, and one key thing is never get into a business without understanding the risks. So I think today we'll be covering a few tools that will make you manage your risks when it comes to trading.
Sure.
So we'll do the risk management with our ATR and risk management with the Parabolic SAR. We were to do a custom position size calculator, so we'll see if we can be able to fit that in. Yeah, so let's get into it.
All right, so ATR is the average true rate, right?
Yeah. So some of these indicators traders are very familiar with. So it's just a matter of tweaking them to see how we get into them using a risk management perspective. Because at the end of the day, when you're coming up with a risk management strategy, the first thing you need to understand is you can't neglect it as part of your overall strategy. Because a lot of traders have this notion where you only need to be worried about your entries, and they end up neglecting what you do after you've placed that trade. So a lot of trading ends after you've pressed buy or sell, and that's it. And risk management is really what you need to be doing during your trade and after your trade. And at the end of the day, you find that if you are able to manage your risks, then the upside is able to take care of itself. So definitely we will be covering a few tools, but then you also have to be open-minded, because there are so many ways you can manage your risk, and there are so many ways you can get into the markets knowing what to do in terms of the different types of risks that are there. So this list isn't extensive. There are still a number of risks, even outside the scope of this session, in terms of psychology, in terms of what to do even before the trades. There are different types of instruments, and assets have their own different types of risks. So all those small details also still count. So this is as far as we can do the very basic and the very fundamental aspects of managing your risk. Yeah, so when you're developing a trading strategy, it's very crucial to also include a risk management strategy of your own, so that it's an all-rounded system that you have with you.
Yeah, so in a trading strategy, we'll have rules on how you can enter your trades and exit your trades. And just like you said, you see, whenever you have your trade executed, then you only have two outcomes, either a profit or a loss. And how you manage the two is what is very important. And yeah, so it's always important to always make sure that the amount of money which you're losing is known, and you know how you're going to handle the trade in case it goes south.
Because if you think about it, yesterday's the market moved quite volatile. It was very volatile yesterday during the CPI reading. So again, in situations like that, you need to be very prepared, and you need to be very aware of the potential outcomes that are going to occur if you're in that trade, and that's part of our risk management.
Sure. So in addition to the stop loss levels and looking at the support and resistance areas and all other approaches that we've talked before, ATR is a tool that can be used to check out the best levels that you can put the stop loss, where you can actually admit that at that level of risk, I'm not willing to take anymore. Yeah.
Yeah.
And looking at the volatility is checking out how far can the price move away from the current position. Looking at the volatility, because volatility is the movement of the price. Okay.
Exactly.
So it's part of the risk strategy. So it's an indicator. ATR is average to range. It's an indicator that helps to check out the likely levels, okay, that a trader will need to check out for. Of course, you'll have to consider other aspects like the support and resistance or the barriers that you have in the chart. Okay.
Yeah. So when you think about an ATR, it simply measures the range, like what is the maximum or the biggest range that single candles are covering over time. And if you really think about it, what it's trying to do is measure how volatile the market is. And if you're able to know how volatile the market is, then you're able to understand how far you need to place your, I'm really preempting, but you need to place your stop loss and take profit. Because at the end of the day, if you understand the potential or the potential distance of how the market is going to move, then you're able to place your stop loss in a very safe distance. And that's one big problem with traders, is how close or how far should your stop loss be. If you set it too close, then you're likely going to be hit. The stop loss is likely going to be hit even before your trade matures. And if you place it way far, then it's going to lead in some instances to a very large loss. So a lot of the times traders tend to struggle with the correct area to place your stop loss. So in this case, if you use a certain approach, like in this case, volatility, then you're able to have just the right distance or the right space, not too close, not too far. And it's based on volatility in this case. So you're able to either avoid being whipsawed out of the market if you're correct, or you're able to avoid setting your stop loss too far, in that when even you're wrong, you get an even larger loss than what was being expected. So in that case, that's why you're using the ATR. Yeah, Matthew, you want to take us through how to read the ATR?
Yeah, looking on the charts that we have right now, is you have price action and then you have the ATR, average to range. So here we're looking at the likely movement of the price from the current level, so that if it extends, if you can look at the number of pips, okay, that you likely to have, the movement you're likely to have for that candlestick, then you can use it to set out the stop loss. So we have a few notes here. So you're just reading the ATR as 0.0019. For example, that's Euro USD chart. And that one can be interpreted as 19 pips. So when you're setting out your stop loss, then you want to consider that the average true range, the range that the price can move within within that specific time, and you're going to use it to estimate where you can put your stop loss. Sometimes you won't use exactly the same number of pips that you're seeing on the ATR, or you can extend it a little bit if you want to be a little bit more risk averse. So going back to this ATR, check out the reading on the left, and you see it's 19 pips. So if you're putting out the stop loss, if you enter a trade there, for example, to the downside, because this one might suggest you go to the downside, then you want to set your stop loss at 19 pips away. But again, like I mentioned from the beginning, it's also important to look at the previous, to also include other practices that we use to manage risk and to set the stop loss. For instance, you would want to have the stop loss at the top. Okay, that is, let me just indicate. You want to have the stop loss at the top here. So if you enter the trade here, you sell at this point, the downside. So, you know, you might have 19 pips up to this level. I've not calculated in this case, but if you have, this is on 1 hour, this one might be 19 pips, for example. If this one is 19 pips, then it's always better to have it above the technical value, which is this resistance. And in this case, that's where now you might want to set it twice. Maybe this is where we're having that 8 pips. So you still would want to use it as a multiple of the ATR, which is here, and still consider other factors that you'd have used to place the stop loss without the ATR. Okay.
Yeah, because you can basically choose between the two. So sometimes if you are more conservative, you can say the higher off between what you get from the ATR reading and what you get from the actual technical level. Or you can even opt, if you're more aggressive, to do the lower of the two, between 19 and 38. Maybe if the technical level is slightly higher in this case, then you can choose to go with the ATR level as a stop loss level.
Sure. But then let's bring in other aspects that you consider in risk management. It's always important, in as much as you are using this ATR, as much as you place your stop loss a little bit far away from being wicked out, also look at the amount of risk. It should align with the amount of risk. Is it a 2%? Yes. Is it align with your 2% risk? Or is it not? Is it? It should not be exceeding. For example, if you're having it at that 8 pips, that is double the ATR, which is ATR times 2. Okay, this is ATR multiplied by 2. That's why we are getting that 8 pips away. If, for example, this that 8 pips away is going all the way to minus to a bigger negative that you are not prepared to risk, then it's important you reconsider the lot size which you're going to use in that case, because you want to keep a consistent risk, not bigger than a percentage. Let's say maybe 2%. That's what we advise. Or maybe if you're taking a bigger percentage, is 5%. You know, it's always at someone's discretion, depending with their risk appetite. But always consider how much are you losing, even at that ATR level. However best it is, and far away it is, be careful not to erode your capital while setting it at your best, at best stop loss level, because this market can move anyway. Yeah,
that's true. Yeah. So if you have, say, 2% for 38 pips, then now you need to know how to adjust your volume or your lots so that it fits into that a parameter of 2%.
Sure. And I believe in one of our sessions, we shared how to estimate the lot size. Okay. You consider the stop loss distance and the risk amount and the pip value for a standard lot of that given currency that you have.
Yeah, true.
Yeah. Now, moving on to our next tool that you can use, it's the Parabolic SAR. And maybe before we move to that, I can share the MT4. So we look at an example of what we're talking about. That will be better before we move on to the next tool. It will be better if we consider that. For instance, let's go to Euro USD. Here we have it. Maybe 15. Let's go to 5 minutes. Let's check out for an appropriate time frame where we can analyze and find out. So for instance, looking at this Euro USD, and this was our analysis during the day. Let me remove all this because they're already done. We're already done with that. So if, for example, we are looking at a likelihood to go short based on this,
that's
if
a
we were to
pendant.
place a stop loss. Yes, Sam?
Is that a pendant or
kind of more of a wedge, looking at it.
okay.
Yeah, I'm trying to find out a structure that you can trade currently. So if we were to enter a trade maybe to the downside in this case, was looking at the RSI is going below 50 and price bouncing below, against that resistance. So let's check out on ATR. Let me add an ATR. I go to insert, check out on indicators, and I think it's on the custom. Or it's on the oscillators, average true range.
Yeah.
Click on it, and we set at the default period, right?
Yeah.
Okay.
A lot of these indicators are meant to be used as by default. So tweaking them really does change a lot of concepts intended by the creator of indicators.
Okay. Thanks for that addition. So looking at the left side of that indicator, you can see we have 0.0010. So that's 10 pips. Okay.
Yeah.
That's 10 pips away. So if we're looking to go short, looking at our setup here, then it means from the current level where the price is, that is where we have 10 pips. And it seems it's exactly at the top of the wicks. I don't know whether we can read it. Let me zoom a little bit. If I use the crosshair to get those number of pips from here to that top, it's around 11 pips. It's exactly at the top. But I remember sometimes you want to have the stop loss a little bit far away from that top of the wick. Okay.
Yeah. So the first option. The first option can be to use 2 ATR. So that's taking your current 10, then times 2, you get 20 pips. I wonder where that will take us to.
It takes us to around that area where we have it's giving us a confluence with the trend line. Okay.
Yeah.
So that it makes sense to have it at 1.00158. Okay. So in this case, I can have this trade on 0.01, check the lot size, 0.03, sell. And then from here, let me drag and have the stop loss at around 20 pips away.
Yeah.
That's
so 0.03 divided by, can I see that?
Sorry, so I did not estimate the lot size. I've just used the lot size just to give an example of how I could have placed based on the 2 ATR that we're having.
Okay.
And then out of this one, you can use different ways to target your profits. Maybe you can use risk reward of maybe double 1.5, or you can as well use the golden ratio to target your profits. For example, here you have
you can even multiply the ATR times the golden ratio.
Yeah, to have the profit. So maybe you can check out on the next on the support, which is below here, because probably the price is likely to test this area, and you can have a 1:1 risk reward.
Yeah, true.
That's how someone would use the ATR. So in this case, a trader gets the the confidence that even if this price is going to move or whipsaw from this point, then you're not likely to be stopped out of this, to be wicked out of this trade because of the normal volatility. Okay.
Exactly. So the whole point of the ATR is so that you're able to avoid being whipsawed out of the market, because you're considering volatility when choosing your stop loss level. Yeah. However, if at all the trade goes against you, then it should be because of some other reason other than the fact that you are whipsawed out of the market.
Sure. Okay, now let's move next to the other indicator, and it's a Parabolic SAR. So simply it's like stop and reverse, right?
Yeah,
Parabolic
So this one
reverse.
This one is popular with trend traders. It's just a series of dots that factor in also again the volatility and follow the price from either above or below, depending on either if you're in an uptrend or a downtrend. So you can use it to trade or follow the trend, but it's a very good indicator to use as a tool to trail your stops. So in this case, if you're trying to book your profit and follow the price, then it's a good tool to sort of trace as price moves along with your position.
Exactly. So I've had you've mentioned something, Sam. You talked about to trail your stops.
Yes.
Okay, so maybe you can tell us about trailing stop, because it's also a tool that someone can use to manage their trades.
Yeah. So when it comes to trailing stops, you're simply booking your profits as you go along. So if you have a long-term trade, a lot of the times you wouldn't want to be in profits, and then after a few hours or days or minutes comes back against you. So the best thing you can do is to follow the price as you go along. So if it's a buy trade, as the price rises, you follow it closely. But then now the problem is, how far should you follow the price with your stop loss? And that becomes a challenge, because sometimes the market tends to reverse before it continues again in your direction. So you don't want it to be too far back. You don't want to trail it also too closely, because you might be again whipsawed out of the market. So it gives you the perfect balance when it comes to following the price with your stop loss as you book your profits.
All right. And here is how the Parabolic SAR looks like. They're just dots. Okay.
Yeah.
For me, I see them like short-term, like the short-term trends. If you want to see short-term trends in the market, check out on the ATR, on the Parabolic SAR.
Exactly. Yeah. So when you're in a downtrend, when you're in a downtrend, they'll be above the price. When you're in when you're in an uptrend, they'll be below the price. So assuming you're already in a profitable trade, like the CPI trade from yesterday, you want to make the maximum out of it. Yeah. The previous one. Yeah. Is that? And then there's this CPI. Yeah. So you'd want to make the maximum out of it. You wouldn't want to exit early. So the best thing to do is to follow the price with your stop loss. And what's the best distance to follow the price? Just look at the SAR levels and go with the flow as they continue to be plotted on the chart. That way you'd end up exiting at around 1.0026, where price is currently at, if you were to be right in this trade. And that way you'll have maximized the trade, because the final dot in that downtrend is where you'll have exited.
So you mean this dot here? Your trade.
So the next one is where you'll have been exited. So you see, you've taken advantage of the entire move up to that point, which is better than probably having a predetermined exit level, because again, price sometimes might work in your favor. So yeah, you just maximize on it.
Great, thanks for that. So now I think we've just talked about it, the explanation. Then we can go and look at it in the charts. But before that, it's good to note that it's better in trends, just to highlight it again, like you said. And when you're in a ranging market, the parabolic SAR might not give you the best levels to trade. Yeah.
Yeah. True. Yeah.
Yeah. Maybe use it in a different way, like to enter trades or fight short-term trends within a range, and can be better. And by the way, for these tools that we're using here, remember you can use them for different approaches, for different trading approaches. Like you can as well use the ATR and parabolic SAR even to find entries. Okay, you can use the parabolic SAR to find the volatility, and when the volatility has gone down in the market, and when it's gone higher, and in that case, find entries or know the best times to trade. But for now, we just using them to manage the risk. So let me check out on MT5 this time around. I hope
so you can have a trade, a hypothetical trade, and then you see where you would have exited if you're using parabolics.
Okay, so here I have an RSI and I'm moving up to moving averages. Well, let me insert. Go to the insert indicators, and then on the trend, I will have parabolic SAR.
Below moving average. Yeah.
Parabolic SAR. You can change the color of the dots if you want them to be red. Let me have them red. You can change the size if you want to see them as a bigger size. And they don't change any other parameter. Just click set, and you will have the dots. Of course, when they have an uptrend, they are just below the price. It's a downtrend above the price.
Yeah.
So in this case, for instance, if someone could have entered at this level where we had the break of, we had a double top here, we had the break of the trend to the downside. Let me just highlight it. I'm looking for the objects. Where do I get the ships? Okay, here. And at the break of this level here, if someone entered the trade to the downside, then you can see how you could have moved the stop loss, right? Just go dragging it lower and lower. If you entered there, and then you have your stop loss at this area, and the trade moves as expected, then just be moving lower, like jumps that point there. As the price goes lower, then it jumps the next level, up to the point where the price just pulls back and hits it.
Actually it wasn't hit over there, because you can see they're still forming. There was no dot below. So price went ahead up to the last one, the very last one at the bottom. The very bottom. Up
to the bottom, up around it. Maybe it could have been hit around this area because of this pullback, but you never know. All the same, it's been good. There have been good indicators of where you might have had reversals. Okay,
because immediately price touches it, it usually appears on the bottom. So in this case, you can see it worked really effectively because price didn't touch the SAR at this point.
And that's how you could use them on the charts. So let's check out on the other tools. Wow, that's the tool that we had, those two tools that we had, and we check out on the examples.
I think we'll have a very extensive session during the classes for custom tools, because there are a lot of tools you can use to manage your risk, and there's a lot traders can learn. If we started talking about risk management, then I believe we'll require a whole 2-3 weeks just to discuss that. But what we have today is very adequate, because the first thing you need to know is when you enter a trade, how far your stop loss should be, and then what to do during a trade, because sometimes you need to book in your profits. So how to trail your stop until the point where price now moves back against you, but you'll be sitting comfortably with a good profit. So there are those two things that you need to think about: what to do before a trade, what to do during a trade, and what to do after your trade has after you've done your trade. And that way you're able to have a well-rounded strategy, even being able to repeat the same strategy over and over and over. Because a lot of the times, if you enter a trade and it doesn't work out the way you wanted it to, then it disorients you completely and you're forced maybe to even change the strategy. But if your strategy encompasses those three things, before, during, and after, then you're able to be more consistent in the market.
Sure. So I'm looking on our chat here, and we have greetings from our attendants. Hey Boaz, hey Lawrence. And interesting question here, global media. Wanted to know where you're located in Eldoret, Sam. I want to leave that one for you, to you. Say where you are at Eldoret, where you're speaking with everyone from.
So you can find us at Trooper Mall. I believe everyone who is around knows where it is. Third floor.
Okay, awesome. Trooper Mall, third floor. Okay.
Yes.
All right.
In Nakuru, Mathew?
In Nakuru, I'm here at Tower 1, that floor as well, just at this at the center of the newest city in Kenya. And we have our physical classes from 1 to 2:30, 4 to 5:30. And if you come at any other time you want to consult, of course, we will be here to speak with you. Okay.
Yes.
Thank you so much, George, Meg, as well, for taking your time to be here. Let me also add as to why we are giving very simple tools, because trading is meant to be very simple. The tools you're using, the more complex tools you use in your trading, the more time you will take to interpret them and also be paralyzed from taking a trade. You do not want to overanalyze the market up until things are too difficult now for you to even take a trade. So simple tools and your trading becomes simpler. But as well, for the people who want to learn, you do not want to start with something very complex. You don't want to have a chart which is clouded with a lot of tools and becomes difficult. Actually, it becomes very difficult. Most of the traders who find trading hard is because you maybe checked out an experienced trader's chart is full of moving averages and a lot of things that are added there. And you even get discouraged right from the beginning. Yeah. So
exactly. If the process is too complicated, or if the tools you're using, you find that they're too complicated, then they serve one purpose. They're going to distract you from the main, the heart of what trading is, which is focusing on the price. So if you have too many things around you, you lose focus on what is really important. So it's best if you're able to simplify the process as much as you can. And this helps you to also repeat it. If something is working for you and you can repeat it effectively, then that's when you get results. But if it's very complicated, then you have a harder time trying to trade profitably in the markets.
Exactly. So I think up to that point, that's what we had this evening. You can follow us on our socials, check them out on the screen. We'll be happy to interact with you. So thank you so much. Have a good evening. See you next time.
And a good trading week. Right.
Yeah, sure.